So picture this. You have a local logistics company, right? And they are pulling in roughly $20 million a year in revenue.
Which is, I mean, that is a very solid operation.
Oh, absolutely. On paper, it looks like an absolute gold mine. I mean, they have a massive warehouse, a whole fleet of trucks, and these incredibly loyal clients who've been using them for literally
Yeah,
decades.
the kind of business that anchors a community.
Exactly. But let's say tomorrow morning, the founder just, well, forgets to come to work. Not a planned vacation, just doesn't show up.
Oh boy.
Right. Suddenly, the entire business just grinds to a total halt. The dispatch software won't load because he's the only one who knows master passwords.
Right.
The biggest client calls with this complex freight issue, and nobody else knows the handshake agreement on pricing that was made on a golf course like 15 years ago.
Yeah, that happens way more often than people think.
It's wild because that company isn't actually a multi-million-dollar asset. It is a really fragile house of cards. And that specific scenario, that is the real threat behind a narrative you have probably heard endlessly on the financial news networks, the silver tsunami.
Yeah, the silver tsunami. When the media uses that phrase, they're almost exclusively talking about this massive, unavoidable reallocation of capital.
Right, all the money moving around.
Exactly. They frame it as this impending flood of retirement funds, estate taxes, and just, abstract numbers moving from one generation's bank account to another. It's treated as a purely financial event.
And that framing entirely misses the point. So today, our mission for this deep dive is to look right past those financial headlines. We want to uncover a hidden, frankly terrifying crisis that is lurking inside millions of privately held American businesses right now.
It really is a crisis.
It is. And to do this, we are pulling from a deeply insightful analysis by John F. Hendershot, and we are grounding his operational theories with some really hard demographic data from the World Health Organization, the U.S. Census Bureau, and Cerulli Associates.
Which I have to say is a phenomenal collection of sources because it forces us to basically dismantle our most basic assumptions about the economy.
Right.
You see, the traditional understanding of the silver tsunami focuses heavily on the macro level. You have financial analysts tracking trillions of dollars that are about to change hands. You have wealth advisors obsessing over estate strategies and major investment firms mapping out demographic shifts simply to, well, predict stock market trends over the next 2 decades.
They just want to know where the money is going.
Exactly. They are all asking the same questions. Who is inheriting the money? How will the government tax it? And where will be invested next?
Okay, let's unpack this, because Hendershot's core thesis completely flips that narrative on its head.
It really does.
He argues that the greatest risk to the economy isn't actually the fact that business owners are retiring and moving their money around. The real danger, the crisis hiding in plain sight, is that millions of these businesses are just not operationally prepared to survive without their founders.
Yeah, those are two entirely different conversations playing out in parallel universes.
Right.
One conversation is about transferring wealth on paper, but the other is about whether the actual engine that generates that wealth will, keep running once the original architect unplugs themselves from the machine.
And to really understand why this is such a massive issue, we can't just say, oh, well, people are getting older. We have to look at the sheer overwhelming scale of the demographic reality driving this.
The numbers are staggering.
They are. The data from Cerulli Associates alone, they estimate that $124 trillion is transitioning through inheritance and generational wealth transfer over the coming decades.
Yeah, 124 trillion. We throw words like trillion around so casually now, but we really need to anchor that.
Yeah, put that into perspective for us.
So baby boomers currently control about 65% of all U.S. wealth. They hold the overwhelming majority of the economic cards, despite making up, only about a quarter of the population.
Wow. And the U.S. Census data puts a very fine point on how rapidly this is compounding, too. Back in 1980, the median age in America was roughly 30 years old.
Okay.
Today, it has climbed to nearly 40. We already have approximately 62 million Americans over the age of 65.
Which is a huge chunk of the workforce.
It's almost 18% of the population right now. And the census projects that number will hit 84 million by 2054.
And, we are not just looking at an isolated domestic trend here.
Right, this is everywhere.
Exactly. The World Health Organization data shows that by 2030, 1 in 6 people globally will be 60 or older. And by 2050, the global population over 60 is projected to reach 2.1 billion people.
2.1 billion. That is hard to even wrap your head around.
It is. And even more critically for business succession, the population over 80 is expected to triple in that same time frame. So we are looking at a historic, completely synchronized aging of the ownership class.
So we have an unprecedented amount of wealth tied up in the businesses owned by this rapidly aging demographic. But wait, if everyone in the financial sector knows these founders are aging, why isn't Wall Street already pricing in this potential collapse?
What's fascinating here is the blind spot of the broader financial sector.
What do you mean?
Well, they tend to view this transition through a lens of perfect market efficiency. They assume that privately held businesses function like liquid, easily transferable financial assets.
Like a stock portfolio.
Exactly, like a stock portfolio or a municipal bond. In their minds, you just sign a legal document, the ownership changes hands, and the asset continues to produce dividends exactly as it did the day before.
Right, they just look at the bottom line.
Yeah, they look at the historical earnings over the last 5 years and just assume the machinery producing those earnings is fully intact, that it is documented and totally independent of the person sitting in the CEO's chair.
You know, I imagine it's like inheriting a multi-million-dollar high-performance sports car.
Oh, I like that.
Right, you get the title in the mail, and you are just thrilled. From the outside, looking at the Kelley Blue Book value, it is this highly valuable, highly engineered asset.
Sure.
But when you actually sit in the driver's seat, you quickly realize the previous owner is the absolute only person on earth who knows you have to jiggle the key exactly twice, pump the gas, and tap the dashboard to get the engine to turn over.
Yes, exactly.
Or, I mean, to take it even further, it's like buying an exclusive, highly profitable restaurant where the founder is simultaneously the head chef, the maitre d', and the accountant.
Right, doing everything.
Yeah. If they leave, you didn't just lose the secret recipes, you lost the only person who knows how to appease your most difficult VIP client and the only person who understands the Byzantine payroll system.
That restaurant analogy perfectly captures the mechanism of the failure. And it brings us to really the most vital distinction Hendershot makes in his analysis. A profitable business is not automatically a transferable business.
Wow, okay. A profitable business is not automatically a transferable business. Let's zoom in on that operational reality. Why do so many founders build businesses that function like that impossible to start sports car or that hyper-dependent restaurant?
Because, well, in many cases, what looks like a robust, corporately structured company from the outside is actually just a founder surrounded by helpers.
A founder surrounded by helpers.
Yes, the owner is the operating system. The business doesn't have a standalone infrastructure. It just has a centralized human processor.
And the source material gives some incredibly vivid examples of how this localized knowledge actually functions day to day. We are talking about owners of companies doing tens of millions of dollars in annual revenue who are still personally approving every single vendor invoice.
Which is insane at that scale.
Completely insane. They don't use a customer relationship management software. They manage their biggest, most sensitive client accounts entirely from memory.
Right. Or they have an undocumented pricing logic living in a series of complex, macro-heavy spreadsheets that literally only they know how to update.
Exactly. Decades of crucial, nuanced operational knowledge exist in only one place, their head.
And when knowledge is that localized, the business completely lacks transferable infrastructure. We aren't just talking about missing a few training manuals.
Oh.
There are no documented workflows that a new hire can study. There's no true management reporting cadence or operational dashboards that tell you the health of the business at a glance.
Nothing's scalable.
Right. And most crucially, there is no scalable middle management. If a junior employee has a question about a production delay, they don't consult a department head or check a digital workflow tracker. They just walk into the owner's office and ask what to do.
Okay, I have to challenge this premise for a second.
Sure, go ahead.
When you describe an owner knowing exactly where every dollar goes, remembering what a client likes, and catching production issues in real time, I mean, we constantly celebrate that.
We do, yeah.
That is the mythological, hard-driving entrepreneur, right? The person who sleeps under their desk, sweats the details, and knows their business inside and out. We literally write books praising that level of obsessive dedication. Why is that suddenly a liability? Wouldn't a buyer actually want to acquire a company with a history of that kind of hands-on leadership?
I am so glad you brought that up because that tension between early-stage startup culture and late-stage business maturity is exactly why this problem is so deceptive.
Okay.
You're absolutely right that in the beginning, intense centralized control is highly effective. It is what gets a business off the ground. But there's a huge psychological trap here. Revenue growth creates the illusion of organizational strength.
Meaning, if the bank account is growing, the founder assumes the company is maturing.
Precisely. When a company scales from 1 million to 20 million in revenue, everyone, the founder, the employees, the local bank, they all assume the underlying operational structure must be rock solid to support that kind of money.
It just makes intuitive sense.
Right, but growth and operational maturity are not the same thing at all. Founder dependency feels incredibly efficient to the founder because decisions are made instantly, without any corporate bureaucracy. But they haven't actually built a company that can stand on its own 2 feet.
What have they built then?
They have built a highly demanding, incredibly lucrative job for themselves. That hustle culture mentality works brilliantly right up until the exact moment a transition begins.
Because the moment they try to sell it, the buyer realizes the asset is the person, not the business.
And that is terrifying for a buyer. The lack of infrastructure transitions from being a quirky hallmark of a dedicated founder to a massive financial liability.
But that liability doesn't just threaten the owner's retirement fund or the buyer's portfolio. We really need to look at how this operational failure leaks out into the broader world.
It really does.
We've established that the founder is the system, but what actually happens when that system suddenly unplugs? The demographic data points to a cascading effect, starting with something called the double threat.
Ah, yeah, the double threat. This is where the math of this demographic wave becomes truly alarming. Because we aren't just talking about the ownership class aging out.
Right.
The workforce demographics present a dual, simultaneous crisis. Workers aged 55 and older now represent roughly 25% of the entire American workforce.
Wow, 25%. That fundamentally changes the math. Because if a quarter of the workforce is hitting retirement age at the exact same time as the founder, you aren't just losing the captain of the ship. You are losing the senior officers, the navigators, and the chief engineers all at once.
Exactly. It is a synchronized brain drain. Businesses are facing the simultaneous loss of ownership knowledge and middle management operational knowledge.
That's rough.
Yeah, the seasoned foremen who know how to fix the legacy machinery, the head estimators who know how to bid a job without losing money, they are aging out right alongside the founder.
So what does this all mean for you, the listener? When that founder system breaks down and their key lieutenants leave with them, it's not just a Wall Street problem.
Not at all.
It is the local Little League team losing its primary sponsor because the new ownership slashed the community budget. It is the regional supply chain delaying your spouse's paycheck because the logistics company they rely on suddenly can't route its trucks.
Right. These businesses do not exist in a vacuum.
Exactly. If a local manufacturing plant doing $30 million in revenue destabilizes because the founder retires and the undocumented system collapses, the ripple effects hit the local tax base. It hits the vendors who supplied them and the subcontractors who relied on their projects.
We're talking about the bedrock of healthcare coverage, apprenticeships, and entire regional economies.
And communities often operate under a veil of ignorance regarding this fragility, don't they?
Oh, absolutely. A town doesn't realize how dependent its local economy is on one of these operationally fragile companies until an abrupt event exposes it. Transition isn't always a planned, gradual retirement with a neat handover period.
Right. It's not always a farewell dinner.
Very often, it is a sudden health issue, extreme burnout, or an unexpected death that forces the issue.
It's the proverbial bus scenario. The founder gets hit by a bus, and the company is instantly paralyzed.
And suddenly, everyone from the mayor to the newest warehouse employee discovers that this vital community institution was essentially being held together by one individual carrying 30 years of undocumented knowledge in their head.
That is a terrifying wake-up call.
It is. The business can't process complex orders, they can't accurately calculate the profit margin on their key products, and customer trust evaporates instantly because the only person the customer actually trusted is no longer answering the phone.
Which brings us to how the modern market is forcing these companies to face reality. Because communities rely heavily on these businesses, how are they actually going to survive this generational handoff?
Well, Hendershot points out that a harsh operational reckoning is already underway for any founder trying to cash out.
Yeah, if we connect this to the bigger picture of mergers and acquisitions, the landscape has fundamentally shifted.
It really has. When these founders finally decide to sell, they enter a market where buyers, lenders, and even key employees who might want to buy them out They start conducting a very different kind of due
A
diligence.
much deeper dive.
Yeah, they start asking hard questions that go way beyond just looking at the balance sheet.
Let's walk through what that actually looks like. Imagine a hypothetical due diligence meeting. The buyer is sitting across the table from a founder who has run a profitable packaging company for 40 years. The buyer doesn't just ask to see the profit and loss statements. They ask, show me your standard operating procedures for onboarding a new vendor.
And the founder says, oh, I just handle that myself. I know all the suppliers.
Then the buyer asks, okay, well, show me the digital dashboard your team uses to track daily production metrics when you aren't in the building.
And the founder replies, we don't need a dashboard. I walk the floor every afternoon. If there's a problem, I spot it.
See, in the past, maybe a buyer would just see a profitable bottom line and overlook that. But today, sophisticated buyers are evaluating something called continuity risk. So
Yes.
how does a buyer actually test or measure a company for that specific risk?
They look for evidence of autonomy. Continuity risk is basically the measure of how likely the business is to experience a severe disruption in cash flow, the absolute moment the current owner steps away.
Okay, that makes sense.
So buyers test this by looking for independent systems. They want to see an executive team that has the authority to make financial decisions without the founder's signature on every single check.
Right.
They want to see a customer acquisition strategy that relies on marketing infrastructure, not just the founder's golf club membership. They weigh continuity risk just as heavily as historical earnings now.
Wow.
Yeah, a buyer looks at that highly profitable packaging company and realizes that without the founder's daily floor walks and personal vendor relationships, the profit margins will likely plummet within 6 months.
They're demanding operational transferability, not just historical profitability.
Because if the business relies entirely on the founder's memory, the buyer isn't actually acquiring a self-sustaining business. They're just buying a warehouse, some used equipment, and a customer list.
Which isn't worth nearly as much.
Exactly. The true value of the company, the operational intelligence, walks out the front door on the founder's last day and goes to play golf.
Here's where it gets really interesting. Preparing for this transition by documenting workflows, installing software dashboards, and building middle management, this isn't just boring corporate consulting jargon.
No, not at all.
Hendershot refers to it as literal economic infrastructure preservation. The companies that are going to command premium valuations in this market, the ones that will actually survive the silver tsunami, aren't necessarily the ones with the absolute highest short-term revenue.
No, the survivors will be the companies that recognize the trap of founder dependency early. They spent years building infrastructure beyond the founder.
They did the boring work.
Yes, they prioritized operational maturity over maximizing every single dollar of immediate profit. They established documented systems, transferable leadership layers, and absolute financial clarity well before they ever sat down at a negotiating table.
They planned ahead.
They realized that their ultimate responsibility wasn't just to generate income for themselves today, but to engineer an entity that could safely outlast them tomorrow.
So to bring all of this together, the silver tsunami we hear so much about on the news is not just a story of $124 trillion neatly changing hands from boomers to their kids.
Definitely not.
It is a massive, unprecedented stress test of America's privately held business sector. Over the next 2 decades, we are going to find out if these thousands of local and regional companies are operationally strong enough to survive a generational handoff without causing widespread instability in the communities that rely on them.
You know, this raises an important question, one that builds on everything we've discussed today about localized knowledge and continuity risk.
What's that?
It makes you wonder, with all of this operational fragility exposed and sophisticated buyers penalizing these founder-dependent companies, is there a massive untapped market emerging for a completely new generation of tech-savvy entrepreneurs?
Oh, interesting.
Think about it. Instead of trying to build a new startup from scratch, what if the greatest opportunity of the next decade is for digitally native operators to step in, buy these fragile, unsellable job businesses at a steep discount, and simply build the digital infrastructure, dashboards, and workflows that the retiring founders never did?
Wow. Buying an analog, founder-dependent cash cow for pennies on the dollar just to digitize it and flip it into an operationally mature asset.
Exactly.
That is a completely different way to look at the businesses you drive past every single day. Well, thank you so much for joining us on this deep dive. The next time you see a successful local business, maybe ask yourself, who actually holds the keys to that sports car, and does anyone else know the trick to start the engine? Until next time, keep looking beneath the surface.